What a roller coaster month June is turning out to be. From presidential politics at home to bailout of Spanish banks in Europe, there seems to be no respite from the edge of the seat suspense. Only European Cup and French Open provided the much needed relief. Talking of European Cup, grapevine has it that the Greek national team were wearing Germany's name at the back of their jerseys. When asked why, they said after all, Germany was their official sponsor. Let me start with the bad news. The warm reception accorded to the Spanish bailout faded rather quickly. While Greek election results has provided immediate relief, it is more than likely that if not an exit from Euro, the bailout terms will come up for renegotiation and the outcome could be messy. In a way, life for European leadership is back to the period leading up to the last Greek bailout. Back home, challenges seem to be mounting at an alarming rate for the government. Key economic data were not encouraging, even though the net tax mop-up during April-May was a massive 173% higher compared to last year. The gross revenue growth at 4%, resulting from a drop of 3% in corporate taxes and a growth of 10% in personal taxes, was disappointing. Only by reducing the outflow of refunds by 55%, thereby indirectly penalizing the honest taxpayers, the government managed to record the modest growth in income tax collection. In May, despite a weak rupee, exports declined by 4%, reflecting worsening ground realities in the rich countries. FIIs spent the week on the sidelines with an ever-watchful eye on rupee dollar, which ended the week short of 56. S&P's threat of downgrade had predictable official reaction that we are far better than what S&P makes out to be. Fitch joined the party by downgrading India's outlook from stable to negative. Finally, yesterday, rather unexpectedly, RBI left both repo rate and CRR unchanged against a consensus expectation of a 25 basis point cut in both. The message was clear. The government has to tango by reducing the fiscal deficit first. Nifty understandably swung 3% through the day, sharply lower at 5062. But it may not be as bad going forward. Central bankers from Fed to ECB to Japan are all aligned to launch into a stimulus, call it QE3 or another LTRO. Collectively, they can't let the default spread. While a recalcitrant Greece could be shown the door, it is hard to encounter the fallouts of a contagion spreading to Spain and Italy. In the past, QE equivalents had pushed risk assets higher. It is entirely possible we might see an encore. In the US, home equity rose in Q1 to the highest level since 2008, indicating the burden of home loans have started easing. Further improvement could become a game changer if house prices also start recovering in response to the changing sentiments. Saudi Arabia broke ranks with OPEC to keep oil prices in check. Commodity prices continued their fall, with major indices recording 20% decline year on year. How political intrigues can so easily turn on its head. The markets last week reflected a great deal of optimism in the face of grim economic landscape when Mamata Banerjee unsuspectingly woke up a spineless Congress back to life by trying to scuttle Pranab Mukherjee's candidature for presidency. In the process, not only has she furthered his prospects, but the market now expects to see Manmohan Singh following up on reforms when he is likely to take up the charge of Finance Ministry post G10 meeting next week. Finally, with rupee at 56 to $1, change of incumbent in North Bloc, and emergence of Congress Samajwadi Party Axis, I wonder whether FIIs will now be inspired to open their purse strings for Indian equities. After all, in January, under similar circumstances, FIIs had roared into India with a shopping list of $8 billion worth of equities. With DIIs on the back foot and retail investors licking their wounds, return of FIIs can play a crucial role in lifting market sense. The rest of the month promises to be a roller coaster ride. The final vector of the forces to be unleashed by Greek elections, RBI's decision on rate cut, G20 meeting, EU summit, and the fate of QE3 is very hard to call. At Percentage Play, we are not in the habit of assuming event risk and are content to sit through these major developments without tempting fate. Nifty, by the way, ran out of steam at the crucial resistance zone between 50.50 and 51.50. At close on Monday, the chart looks deflated, waiting for fresh clues to emerge. QE3 or a resolute Prime Minister will have to show the way. Last week was not particularly flattering for quantitative pair fund. We took our losses in Allahabad Bank UCO Bank pair, but both of our new pairs are in profit. The market having moved up and down, our outperformance record also was volatile. In the context of uncertainties plaguing the global markets, we are happy to be up 30% over Nifty. Our reluctance to assume event risk was vindicated on Monday when the market unexpectedly tanked in reaction to RBI holding rates. We stayed out of the market all of last week, except booking some profit in the swing position in L&T and entering TCS on Monday as a breakout candidate. While the market may well pick up steam on its journey towards the rest of June, we prefer to be patient until we can figure out the implications of the unfolding events. Percentage Play is now all excited about the launch of its quant trading systems. A product of focused research, we are starting this window to help traders make the right calls. Watch this space.